Welcome back to the Scholar Wealth Podcast. Today we're tackling two timely questions at the heart of long-term planning. First, we'll look at what to consider when deciding whether to convert a 401k balance into a Roth and the strategies that can help minimize taxes if conversion isn't the right move. Then we'll turn to the headlines about gold hitting record highs and how investors should be thinking about gold as part of their portfolio right now. And for today's From the Field segment, I'll be joined by Lindsay, founder and CEO of Logic. Lindsay and her team have helped thousands of students tell their stories and gain acceptance to top schools, and she'll share her perspective on how high net worth families can navigate today's competitive admissions landscape. So let's go ahead and get started with question one.
I have a significant amount of money tied up in a 401k. What should I consider when deciding whether to convert to a Roth? And what strategies can minimize the tax impact if conversion doesn't make sense?
What we first need to do is take apart the actual trade-off that happens with the tax-deferred and Roth aspect of your 401k. When you're trying to make that decision, typically you're looking at an assumption. And it sounds like you're getting into this case where the assumption is I'm going to put money into a 401k now, tax-deferred, because I'm earning now. So I'm in a higher tax bracket with the expectation that once I'm retired, my tax bracket will drop. And then you would have made that delta between the two tax rates and work out great. That works for a lot of people. The only problem is if you start to build up a significant amount of money within the 401k and it's all tax deferred, the issue is the government still wants their tax money later on. And you deferred a lot of money that needs taxes later, which means when you start pulling money out of that account, you're going to be taxed on that money as income. That tends to be not too much of a problem if you're pulling out a reasonable amount. Where it becomes a problem is what happens with RMDs later on. So your 70s with required minimum distributions, this is where the government starts looking at you and saying, hey, you promised you were going to start paying tax on this money. You haven't. So we're going to start requiring that you take a distribution from your 401k or from your IRA. So that way they can actually see that account depleted and therefore their taxes paid on it. So if you're still working, obviously we have to take some assumptions here on the details, but if you're still working, then you may want to start considering decreasing those 401k contributions because that assumption of being in a lower tax bracket later doesn't sound like that's going to be the case anymore. So because that assumption has changed, that means the decision criteria has changed, and pulling money out of that contribution to the 401k and instead making contributions to something like a brokerage account or changing contributions to Roth could also be an option with 8 contributions now. All could be possible outcomes. Now, if you don't have the time to do that, and maybe you're already in retirement, you have your 401k and it's loaded up with tax deferred, then we have to be a little bit more strategic around Roth conversions and timing them. So one thing we need to do in the first thing is we need to run some tax projections on this. I would start looking at how much money are you going to be pulling out every year from this account? And is there room for you to convert a little bit more without going into the next large tax bracket? When I mean that next large tax bracket, or tax brackets are set up where there's two pretty significant jumps. There's the jump that goes from 12% to 22%, and then there's the 24 to 32% brackets. So your tax brackets will go 10%, 12%. That's not a jump I'm worried about. If you're paid 10%, go ahead and pay the 12%. It's a 2% hedge against future tax rates increasing. I'm definitely concerned about the 12 to 22% jump because that's a 10% extra marginal tax rate on every dollar. So if you're converting up to the 12%, that's great. If you start converting in the 22 and you're pulling out enough income from your portfolio, which is most of the time the case, to where you're already in the 22% bracket, then you can go max out the 22 or even the 24% bracket before jumping into the 32. I'm a fan of capping out that 22 and 24 just because I feel the tax rates are pretty low historically from any metric that we use. And typically if your country is running a deficit and you're at low tax rates, really easy way to knock down that deficit is to increase that tax rate. So when we're looking at decades of retirement timing, being able to hedge against that future tax rate increase by converting at the 22 or 24% bracket can make a lot of sense. We do have to be careful though, that if you go convert too much too early, let's say you look at your account now and you max out the 24% bracket with hundreds of thousands of dollars of conversions. What that could also do is set you up where you have a lot of conversions now happening at 24, but 10 years down the road, your tax bracket actually drops down back into the 12% bracket. And missed out on that opportunity. So in most cases, you're doing sort of partial conversion throughout retirement where you're going to start converting, you're going to pick a level of conversion that keeps you kind of the Goldilocks scenario throughout retirement of converting enough where you're taking advantage of lower tax rates, but not converting so much that you end up dropping into lower tax rates later. Now, after all that is taken into account and you've done some of your tax planning or some projections, if at that point you look at it and say, Stephan, there's still too much money here, I'm not spending it, and I'm going to have these huge taxes from R&Ds and I don't need it, then you can start looking at things like QCDs, doing some charitable giving, taking your R&Ds and giving them to charity qualified charitable distributions. But one that could make a lot of sense, especially if you're doing a lot of Roth conversions earlier on, is really starting to think about asset location in a real way. In other words, if you start converting and now you have a pretty sizable Roth bucket and a pretty sizable tax deferred bucket, those asset allocations should be very different. Let's go put the high growth or high expected growth assets in the Roth, and let's go put the boring stuff, the low expected growth assets like the bonds, into the traditional IRA or the traditional 401k. So that way, over time, that growth slows, which therefore decreases your requirement of distributions out into the future. So lots of good options there, depending on what phase or what stage of the 401k contribution withdrawal process you're in. And now we can jump into our next question.
I've been seeing all these record high gold headlines. It seems like I should consider more gold in my portfolio. What do you recommend?
The key word in your question is more, which is showing us that you have some allocation to gold already. And then I would throw the question back to you and ask, why was gold in your portfolio? So what percentage did you have in there? And what was the purpose of adding it into the portfolio? And whether or not the assumption then has changed from your assumptions now about the economy and the market. Why I say that is because it's very common that when we have anything, whether it's gold or technology stocks or AI or Bitcoin or stocks in general, we always run into these situations where you build out an asset allocation. You say, I did all this work to determine what is the appropriate weight for gold in my portfolio. And maybe you've drawn in on the fact that you should have 5% of your portfolio in gold. And you say, that's the number, 5% in gold. And now gold does great and continues to grow and it's doubled and moves. And now it's 7 or 8% of your portfolios. That is a great feeling. Portfolio keeps going up. Should I add more? And that is the greed portion of the fear and greed dynamics in behavioral finance that we have to be really careful about, because we have to see why you would want 10 to 15% gold, for example, in your portfolio now, when a year ago or 2 years ago, you only wanted 5 in your portfolio. Has enough changed on your assumptions around the economy and the markets to say that you would like to increase your gold amount in a large way? So that's the first question. I would take a step back before looking at anything related to gold's increase in price over the past year or the large returns, and say, what is gold's role in my portfolio? And have I met that? In many cases, the role of gold is going to be inflation protection. It's going to offer some diversification. It could offer some hedge against uncertainty. But when we're talking about hedges, especially hedges that don't provide a cash flow, as the case of gold, very rarely do we want that to be a large portion of the portfolio. So we want to be careful there that we're not just chasing returns, and instead we're looking at this from a 10,000 foot view of saying, do we actually need gold? What is its role? And what are the other commodities maybe we could add to this? In other words, if your goal is inflation protection and you have gold already in there, then is this a good time to add any other kind of precious metals, any other kind of commodities to the portfolio to also diversify away from gold as an individual asset in the portfolio? So we have to be careful of that overconcentration whenever we're seeing this increase. Now, when it comes to the percentage of gold in the portfolio, lots of different ways to think about that. In fact, here coming in November 13th, where we have a webinar to go over just that. We'll talk about the relationship between gold, inflation, the relationship between gold and the dollar, and how to think about it as a portfolio, and really talk through what those percentages would be for different people on different types of portfolios. But in your case, when you're looking at all the record high headlines for gold, that is the least useful information. But anything that goes to past performance, that is the grand phrase of finance. Past performance is not indicative of future results. In fact, the research would show that it's the opposite. If a company has done really well or an asset class has done extremely well over the past year, the odds that it does really well for the next year is very low. That's why value stocks tend to outperform growth stocks over time because value stocks are the ones that have dropped. So whenever you're looking at a stock that has had a great run over a year, the odds that it continues to have a great run the year after go down. And that's the case for any asset, including gold. So if anything, the way I would look at this is saying you're seeing gold at all-time highs and record highs continuing to increase. What that really should tell you in the back of your mind is that statistically, from a probability perspective, the higher it goes, the less likely it is to continue going up, at least in the short term over the next year or two. So we want to be careful there, take a step back, look at why is gold in your portfolio? What role does it play? And use that as the guide for whether or not you should be adding more now, as opposed to using the guide of current returns as a reason for adding something to a portfolio. For our special segment today, we're shifting gears from financial planning to education planning, a topic that's just as central to many families' long-term goals. Lindsay, welcome to the show. You've built Logic Prep into one of the premier firms advising students and families on Ivy League and top tier admissions for universities. Before we dive in, could you tell us a little bit about yourself and your background, your firm?
Absolutely. Well, first of all, thank you so much for having me. It's a pleasure to be here. So, for nearly 2 decades, my team and I have been supporting families through what is an exciting and sometimes fraught chapter, which is the journey of high school to college. So, I started the firm back when I was a student at Harvard. Really, I was just a kid helping kids. My background and interest is in writing and storytelling. I was an English major, commuting back to my hometown to help what were essentially peers at the time to tell their stories. Now, flash forward, it's been quite a while. We support thousands of students all over the country, all over the world, in bringing their most authentic stories to life and setting up a proactive, thoughtful, intentional path to the schools of their choice. So we now have a team of advisors, all of whom are former admissions officers. They've been on the other side of the desk at schools like MIT, Duke, UVA, USC, and they really leverage that expertise to help manage the inevitable stress of this process and help students and families make long-term, thoughtful, strategic decisions.
So when we're talking to clients, people in these positions, if you're talking to a high net worth family, one of the things they're looking for is where's the ROI? Where in their mind, if they can focus on something to put time or money into to help their kids get into these types of schools, where are those big drivers for helping to get into these top 10 schools or Ivy League admissions?
That's such a good question. There are so many different ways of looking at success in this process. And when we're working with high net worth families, we're specifically tapping into what would you define as a win? Because I think that is really individual on a family to family basis as well. And so you can look at the US News and World Report rankings, and that tells one story, but that doesn't necessarily answer the question of what's going to be the right investment for your student and your family. And so when we're having conversations about rankings or about defining success, we're often talking about things like building your global network, gaining skills to potentially bring back to a family business, thinking about the recruiting pipeline from various schools. And so this is really distinct and I would say individual to the family, but that is inherent to our process to really define what's important to you as parents and how can we support your child on that path.
So when you look and you mentioned rankings, how much do rankings impact the demand for different colleges? I know you're having those conversations and families are coming to you saying, here are our top 5 or top 10 schools we're trying to get into. Do you see rankings impact that at all? Or is it really more legacy reputation of these schools?
I think rankings continue to matter, but I think reputation, legacy is probably the number one driver. I think what's interesting and confusing to families is the variability in rankings lists and just the number of rankings lists out there. There's a lot of noise. LinkedIn just put out a rankings list, and families said, well, should I be looking at that? Like, is that actually important? And then I think that opens up the conversation of, well, what's actually important to you? How do you define success for your child? And so often we're talking about What is the end goal beyond college? What kind of job do you think your child will have? Where do you want them to live and build their network? We're seeing more families actually taking a more global mindset. And even some families are starting to explore options in the UK, in Europe, in Canada, alongside US universities as they just take a more global mindset.
When students are applying, it's obviously their profile, they're writing essays and grades and all these extra, but how much do legacy admissions, philanthropy to a university, or the family profile play a part in likelihood of success, however that's measured, but mostly in the admissions process?
Yeah, of course. So I think legacy admissions and donations are part of an evolving landscape. So some colleges like Amherst, Hopkins, Carnegie Mellon, among others, have explicitly stated that they'll no longer consider legacy status in the admissions process. That said, that's the exception, not the rule. Relationships and philanthropy can definitely still play a large part at many institutions. I just think that for families navigating that, thoughtfulness and discretion is really important. So we advise families on how to leverage the relationships that they may have at these institutions to support their child's application in a way that's going to be most impactful for them.
Can you expand on that a little? What would you advise? So let's say my kids are nowhere near this process. So let's say 10 years from now, they've got a school that they really want to go to, and someone recommends that I make a donation to that school. Because that's the kind of stuff you hear. That seems like a very high level and opaque way to describe that process. Is that really how it works?
I think, as sort of a general rule, more sustained, regular commitment in terms of time, in terms of financial investment over a longer period of time is going to be most impactful. That said, I think colleges are understandably sensitive to perceived overreach. So a well-intentioned outreach, about your 7-year-old is probably not going to be the most strategic thing you can do. But I think establishing a track record of involvement in terms of both time and money is important, which will then culminate in ultimately, likely, the child's application to the school. And then there's a question of what letters are going to be sent or phone calls made on their behalf, and how does that timing and messaging coincide with the student's expressed commitment to that school. So, for example, we advise our students who have legacy connections at particular institutions, for the most part, where the option is available, to make an early decision commitment to that school, because that gives the student the opportunity to say to the institution, you are my first choice. And then if there's going to be background support, it all sort of comes together. Without that student commitment, the background support is probably not going to be as meaningful as it could.
And that kind of ties into another question I was really interested in getting into. What are the mistakes that people make? Because from a parent lens and your child going through this process, you don't have many shots at this, right? Sometimes there's
one shot
going in, right? And that puts a lot of anxiety on that decision. I equate a lot of this to like retirement planning as well. You retire once, so you want to make sure everything's all right. You don't have an opportunity to really go through and say, I made these mistakes.
Yeah.
I really wish I wouldn't have, but it's not like we're going to have another shot. They're in college now and they're at school A. But you have the unique lens of, you see a lot of people going through this process. What are the mistakes that you see made most often that you look back and say it could have been navigated in a different way that would have led to a better outcome?
Yeah, so I'll point to one mistake that I think many well-intentioned high net worth families will make. They have an understanding of the importance of narrative and storytelling as a component of the application process, which is wonderful that they're coming to the table with that insight. And I think sometimes that translates to supporting what are sometimes referred to as passion projects for their children that feel performative or forced or obviously enabled by adults. I think there's a fallacy or a myth out there that one could sort of construct the perfect applicant. And from my perspective, the perfect applicant is really the most deeply engaged and impactful version of your child. So we absolutely support our students in going deeper in their interests, developing a really differentiated, unique, compelling story. but it has to come from a real and authentic and genuine place. So an example I would give of this is we have a student who's actually at Stanford right now, and she started taking Latin as a ninth grader. It was something her school required. It wasn't anything that really was driven by any sort of interest in anything, but she liked it and she found it kind of cool and interesting. And so her advisor said, well, what can we do with that? Well, maybe we can sign you up for an ancient Greek class. Let's go explore the classics, see what that looks like. And she actually really liked it. And then that drove her commitment the next summer to participate in archaeological dig in Morocco. And what happened was we had, by the end of this 4-year engagement, a really cohesive, connected, compelling story that was absolutely grounded in her real and authentic interests that we listened for and cultivated and then helped make actionable.
That sounds like the perfect scenario. Putting off in something, an interest as a freshman, you continue to build on that, which makes perfect sense. In your ideal world, for someone to start this process, when does that process start of starting to have those conversations, that coaching of, if this interests you, let's build on that instead of having this scattershot approach to just trying a bunch of different things? When does that process start? Is it freshman year? Is it out in middle school? Should I be worried now in elementary school? Or is this?
You've got a little bit of time. So earlier is better. So what does that really look like? It looks like probably 8th or 9th grade, and more of our families are engaging with us around that time, which is really wonderful for them and for our team because it gives us a longer runway to make more strategic, more thoughtful decisions together. I also think that planning early is really the antidote to the inevitable anxiety that comes along with this process. Beginning at the tail end of middle school or the beginning of high school allows us to break the process into pieces, to set a long-term game plan, and gives students the space for their story to take shape. Since in an ideal world, it will be an organic evolution of their interests. And then there are just some considerations that families might not be aware of the first time around. And that's why actually we find our younger siblings starting with us earlier than the first child, because parents know more about the impact of earlier decisions on the ultimate outcomes in the process. So for example, one of the earliest and most important decisions a student can make is around 9th grade course selection, which is often happening at the end of middle school. The academic path that a student sets at the beginning of high school can really shape their access to sufficient academic rigor to make them competitive at the most selective universities. And so when we can, we really want to be thoughtful about building the right portfolio of classes from the very beginning of high school.
When you're looking at this at current point now toward the future, what are the trends you're seeing? Are there any advice in the selective admissions process that families should be paying attention to going forward?
Yeah, I think more and more colleges are placing a stronger emphasis on fit and on narrative. And that often takes the form of authentic storytelling for the student really being able to articulate, why do I want to be here? Why do I belong here? It's a crowded landscape. Outside of the story, most students have very similar statistics on paper. Application numbers are tremendous and only growing. And so in a world too, where AI can sort of flatten the narrative, it's more and more important for students to be able to clearly and dynamically articulate who they are, what their story is, and why they're the right fit for those particular universities.
Seems to be the theme throughout all the answers there, which is always good when that all comes together, of just finding that fit and really doing that research. This has been wonderful. Thank you so much for coming on. I know I learned a lot. I'm sure others will as well. Thank you so much.
Of course, thank you.
That's our show. If you're interested in joining the gold webinar I mentioned, you'll find the registration link in the episode description. Thanks for listening, and we'll see you next week. Hey, this is Stephan. Thanks for tuning in to the Scholar Wealth Podcast. If you have a question you'd like us to tackle on a future episode, share with us at scholarvising.com/podcast. We'd love to hear from you. Until next time.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.